as much as I would like to go straight into BlackRock ETF theories and conspiracies with Larry Fink, I really wanted to start with like the basis of kind of like what ISO's journey was, how he got into crypto, how he got into trading, and some of the stuff. Because, like I said, like the stuff he does is obviously working for him, and that was something I remembered like telling Brett. Like it's not like he's emulating somebody and just trying to do this for clout. Like I can tell he's real. I just really struggled with understanding it, but it started to make sense, and now we got him on stream. So, ISO, if you could say hi and I guess kind of kick us off, or how you kind of started, because you ended up with a unique style that had to have a very interesting journey to get there. So anyway, I'll hand it over to you.
Yeah, well, I think first off, this has been a long time coming, given how our relationship online has evolved. To your point, the Twitter Spaces like Mango and Macro during the bear, when like it was you, Stacks, Phil, like a handful of other people, Avocado when he wasn't muted, just basically shooting the shit, talking markets. And I think it really depends where you are in that stage of the market and how it's trading. During that time, we were just running like altcoins up and down based on liquidity theory and using high block, right? Because we were in more of a ranging market, right? And low liquidity, you could tell where the pain points were. I mean, I have a really hard time looking at the rainbow stuff, just because the author is going to understand it the best, and sometimes I'm not as open to learning about other things because I have my own little toolbox of stuff that has worked for me, and consistency and keeping it clean based on the parameters that I need to look at for executing trades is something that has served me well. That being said, I'm always open to look at the other side of it, but I also started to realize that you can look at the same thing in a different interface, right? Like you were finding pain points just through what you were building, but it often matched up with some of the high block liquidity levels that I was using. I think you can agree to that at least, which is how you almost started to re-engineer that in a different way and building indicators around that. So, believe it or not, I was even an Elliott wave trader theory at one point, because those work pretty well in a bull market, and that taught me a lot about Fibonacci. And so one of the things that I use in looking at levels specifically is key Fibonacci levels. It's nothing crazy, like 61.8, 70.5. Those zones tend to match up with interesting liquidity pockets, as well as just basic support and resistance. There are multiple ways to trade just using SR, horizontals, even diagonals. The reason I started to look at liquidity theory was because it helps me understand why price gravitates to those areas. And often it matched up with big liquidation levels. And that also would tend to match up around Fibonacci levels, right? So multiple points of confluence helps you have more high conviction ideas when it comes from like a technical analysis standpoint. Now, to your point about TD was something that I learned when I was working in traditional finance, right? So right out of school, I basically went into equity research. So, to your point about looking at narratives or coins kind of under the hood more so than what the chart is telling you, that's where I cut my teeth. And so I worked mostly starting off in industrials. So I worked for a number of analysts, basically did all the grunt work with modeling, being on top of news flow, communicating things to the sales force, right? That was where I started my financial services career. And I worked in finance for 6 years, and I did various industries, one of them being energy, right? I think we had we talk about that a lot, right? So exploration and production, and then the oil services and equipment space. So the history for me, trading markets, analyzing things, started very early on. Where I learned TD was part of that one was I was on a trading desk. So TD is Tom DeMark, and that's the TD sequential, like basically TD9 buy, TD9 sell setup. So that was just one other thing that I would use as a point of confluence when looking at liquidity theory, fibs, and the kind of the other variables I looked at. And one thing that I use with TD is Stoke crosses, right? So this can be on any time frame. So that's just like, all right, are you crossing on the bottom and it's a TD9 buy and you're around a fib level and you just hit a pocket of liquidity? That is a super high conviction setup on the long side to me. And then on the short side, it would be TD9 sell, Stokes turning over. Maybe you've gone from a significant drop back up to a 61.8 fib retracement, right? So and it's matching up with like essentially a supply zone. So these kind of checklists that I have when trading liquidity range bound markets more so are essentially my tool set and how I look at it. Now, if you look at the market when it's trending really hard, liquidity theory is probably not the best thing. And that's primarily a component of it being a spot driven rally versus, margin pushing up price where that's becoming more predatory. And to be honest, looking at how Bitcoin traded this year and Ethereum traded this year, or shouldn't say this year, 2023 from the start of the year, we didn't have as many crazy liquidation events on the way up. The drops were not as steep and violent. For the most part, it was actually pretty systematic in the way that the uptrend held. And I think that's largely a component of just as the market matures, adoption occurs, also removing a huge bad element of the market, right? Let's call it Alameda, like FTX. That was extreme predatory price movement and manipulation.